Imagine waking up tomorrow, logging into your banking app, and finding $0 in your account. Not because you spent it, not because of fraud, but because the bank itself, the very institution you trusted to safeguard your money, has collapsed. Sounds impossible, right? After all, in medieval Europe, merchants and moneylenders created institutions to hold gold and provide loans. But these banks operated on a principle that hasn't changed. They lent out more than they actually had. This is the foundation of fractional reserve banking. The idea that not every depositor will demand their money back at the same time. It's efficient. It fuels growth. But it also creates a constant shadow. The bank is only safe if everyone believes it's safe. History's most dramatic failures stem from the moment that belief collapses. Before we dive into the modern world, let's visit the early 20th century. To modern banks have become popular, offering higher returns than traditional banks. But there's a problem. Trust companies are less regulated and more leveraged. When a failed attempt to corner the copper market sparks rumors, depositors panic. Crowds gather outside banks in New York City demanding their money. Within weeks, multiple institutions collapse. The stock market plunges 50%. Businesses shut their doors. The panic spreads so fast that the entire U.S. banking system teeters on the edge of collapse. And here's the twist. The government can't stop it because the Federal Reserve doesn't exist yet. Instead, one man steps in. J.P. Morgan, the most powerful banker of his time. He gathers fellow financiers in his library, forces them to pledge capital, and personally orchestrates a rescue. The system survives, but the lesson is clear. One wealthy individual shouldn't decide the fate of a nation's economy. This crisis leads directly to the creation of the Federal Reserve in 1913. America's central bank designed to prevent future panics, but did it? Not quite. Fast forward to the 1920s. The U.S. economy is booming. Jazz, automobiles, skyscrapers, and a culture of confidence and risk-taking. Banks lend aggressively, fueling a stock market frenzy. But under the surface, banks are still fragile. Thousands of small banks operate with little diversification. When farmers or local industries struggle, the banks tied to them wobble. Then comes 1929. The stock market crashes, confidence evaporates. Here's where psychology comes in. Once people fear their bank might fail, they rush to withdraw money. But when everyone does this at once, no bank can survive. That's called a bank run. Between 1930 and 1933, nearly 10,000 banks fail in the U.S. Families lose life savings overnight. Businesses collapse. The economy spirals into the Great Depression, the worst economic crisis in modern history. The response is sweeping. In 1933, President Franklin Roosevelt creates the FDIC, Federal Deposit Insurance Corporation, guaranteeing deposits up to a certain limit. The Glass-Steagall Act separates commercial banking from risky investment banking. Regulation tightens. For a while it works. Confidence returns. Ordinary depositors feel safe again. But here's the twist. Those very protections over time plant the seeds of new risks. Jump to the 1970s and 80s. The U.S. is dealing with high inflation, oil shocks, and sluggish growth. Banks and savings institutions complain that strict regulations, especially limits on interest rates they can pay, are choking them. So policymakers begin deregulating. They loosen rules, hoping innovation and competition will strengthen the system. But deregulation without oversight is dangerous. savings and loan institutions, or S&Ls, start making aggressive bets in commercial real estate and junk bonds. Fraud and mismanagement spread. By the late 1980s, the savings and loan crisis explodes. Over 1,000 institutions fail, costing taxpayers around $160 billion in bailouts. Sound familiar? Risk-taking, light regulation, government rescue, the cycle is repeating. Now we arrive at the 2000s. Banks have grown enormous, global, and deeply interconnected. Financial engineers invent exotic products like mortgage-backed securities and collateralized debt obligations, CDOs. On the surface, these instruments look safe. Ratings agencies stamp them AAA. But beneath the packaging, many are built on subprime mortgages, risky loans given to borrowers who can't realistically repay. When housing prices stopped rising in 2006 and 2007, defaults spiked. The securities built on those mortgages collapse in value. By 2008, major institutions like Lehman Brothers fail. Others, like Bear Stearns and AIG, require government rescues. The world watches in shock as the entire global financial system teeters on the edge. Stock markets crash, millions lose jobs, homes are foreclosed. Once again, policymakers rush in. Trillions in bailouts and liquidity injections.
You might think we learned our lesson in 2008, but history suggests otherwise. In March 2023, Silicon Valley Bank, SVB, collapses in just 48 hours. How? SVB catered to tech startups and venture capital firms. Flush with deposits during the tech boom, it invested heavily in long-term government bonds. Normally safe. But when interest rates surged in 2022 to 2023, those bonds lost value. Depositors noticed. Fear spread instantly through group chats and social media. In one day, clients attempted to withdraw $42 billion, the largest bank run in U.S. history. SVB collapsed before regulators could act. The government once again stepped in, guaranteeing deposits beyond the FDIC limit to prevent contagion. But the event raised uncomfortable questions. How fragile is the system in the age of instant digital withdrawals? Can regulators keep up with the speed of panic in the smartphone era? And SVB wasn't alone. Other regional banks like Signature Bank and First Republic also fell. The lesson? Despite a century of reforms, the fundamental weakness remains. Banks live and die on confidence, and confidence can vanish overnight.
So what patterns connect the panic of 1907, the Great Depression, the S&L crisis, 2008, and SVB? Let's break it down. Excessive risk-taking, 1907. Speculative bets on copper. 1920s. Overextended lending and stock speculation. 1980s. Risky real estate and junk bonds. 2000s. Subprime mortgages. 2023. Concentrated exposure to interest rate risk. Regulatory gaps. Every crisis follows a period of deregulation or oversight failure. Then, after collapse, new rules emerge, only to be weakened decades later. Psychology of panic confidence is fragile. Once fear spreads, no bank can withstand a run. Modern technology accelerates panic. In 1930, depositors lined up on foot. In 2023, billions vanished with a few taps on a smartphone. Now here's the shocking part. Since 2001, over 560 banks have failed in the US alone. Globally, dozens of crises have erupted in emerging markets from Argentina to Greece. And yet, each time we act surprised. So what does history really tell us? First, bank failures are not rare exceptions. They're part of the system, the very design of banking. Lending more than you have, relying on trust. guarantees that collapses will occur when fear outweighs confidence. Second, regulation is a pendulum. After crises, governments tighten controls. But over time, memories fade, lobbying intensifies, and rules loosen again, setting the stage for the next failure. Third, technology changes the speed, not the pattern. Social media, mobile banking, and real-time transfers make panics faster, but not fundamentally different from a century ago. So as we close, let's boil this down to 3 clear takeaways. History repeats. Bank failures are cyclical, driven by the same forces of greed, risk-taking, and fragile trust. Confidence is everything. Banks don't fail because they run out of money. They fail because people believe they will. Reform is temporary. Every fix is eventually undone, whether by politics, memory loss, or innovation that skirts the rules. And here's the warning. We are living in a time of rising debt, geopolitical tension, and rapid technological change. If history is any guide, the next banking crisis is not a matter of if, but when. The open question is this: will we learn from the past, or will we be caught off guard once again? If you found this video valuable, don't just move on. Hit that like button to support the channel